Hello and welcome back to another episode of Teatime Tuesday. I'm Rashan Gidwani, the presenter for PYTCH Media. In 2022, we witnessed China's zero COVID policy, the war in Ukraine, rising interest rates, and rising inflation. According to Ned Davis research, there's a 98.1% chance of a recession in 2023. Talking with me about this today is Roger Chan, Dealing Manager of the Global Markets Desk from Phillip Securities. Roger, thanks for joining me on the show today.
Thank you so much, Roshan, for having me.
So let's dive right in. What's your outlook for 2023?
Okay, Roshan, because the US economy drives the world, a recent Bloomberg economic model projected a 100% probability of a US recession by the end of next year. You have 90%, more than 90% of CEOs in the US coming forth predicting a US recession by the end of next year. Now, if you were to look at the projections and the predictions by these business leaders, who are in tune with the economy, it's fair to say that we are likely looking at a US recession the next year. Before I continue, you need to understand there are different kinds of recessions, right? We have the shallow ones, the shallow, a mild recession. We have the moderate recession. We also have the deep recession, right? The severe and the deep recession. Now, the markets have priced in for a mild, a shallow, and a moderate recession. But what the markets have not priced in is a deep recession. So as long as we do not get that deep recession, we may have an opportunity in the stock markets.
What if we do enter a deep recession? What does that imply?
Well, I would say all bets are off, Roshan. The market has taken, there has been carnage in the market, right? Okay, that is turmoil. For the most part of 2022, the market has effectively crashed. Now, if we do get into a deep recession, all bets are off. I think the market is going to come down a lot more than where it is today.
Now, it's a popular investment strategy for investors to buy the dip. What advice do you have on this?
Well, I would say buy the dip and sell when it's high. But really, it's really hard to say. I mean, it's really hard to do it, right? It's hard to implement, easy to say, right? Because when you are in the markets, there's so much volatility. There's so much turmoil within the investor. The volatility sometimes scare people off. Even after they've bought stocks cheap, dirt cheap, they sometimes fail to hold them. So I would say if you have the temperament, the ability, right, the emotional strength to hold on to stocks and hold them. But for investors who are new to the markets, especially now, there's so much turmoil, there's so much carnage within the markets. I would say practice dollar cost averaging. That would be buying, set aside a certain amount of money every month, to buy into some of your favorite stocks, like $100, to buy into Citigroup, right? And the next month, you set aside another $100 for Citigroup, right? You slowly ease into that investment.
Maybe investors get emotional because they're not sure about what's happening in the market. They're not sure where to get their information. And that's why we have these Teatime Tuesday interviews. So let us know, what are some of the headwinds and tailwinds that are going to affect the market in 2023?
Okay. Before I get to the headwinds and the tailwinds in the next year, Roshan, I just want to briefly touch on the number one headwind for this year. Hands down, runaway inflation. That has actually driven the central banks to raise the interest rates drastically, and which explains the turmoil in the stock market today. Now, the next year, we believe that there will be significant disinflationary pressure. We believe inflation is going to come down the next year. Now, there are reasons for that, okay? Several disinflationary factors are already coming down, okay? Like what? Like number one, shelter cost. Okay, we're talking about home prices and rents in the US. Now, these shelter costs make up 40% of the CPI, Consumer Price Index. And they are by far the stickiest component of the CPI numbers. They have started to come down, right? They were initially driven to record highs due to the pandemic, due to people moving to the suburbs, right? And they drove, shelter, home prices up. But they have started to come down already. You have shipping costs, Baltic freight index. They have come down 70% from a year ago. You have supply chain pressure coming down 65% from a year ago. You have commodities, right? Agriculture, energy prices, industrial metals, precious metals, they are starting to come down. So we believe when next year arrives, these inflationary pressures will work their way through the economy and will show up in the CPI numbers. With these factors, they need time. They need time to work their way through the economy. And we believe the next few CPI numbers will show.
Okay. So you mentioned many different sectors which the investor can kind of look out for to make a buck, to excel in the market. What are you specifically looking at?
Okay. Roshan, you need to understand that the stock market really isn't just the whole market. It really is a sector, or rather a market of many sectors, right? Now, what do I mean by that? You have the large cap, you have the mid caps, the small caps, you have the tech, you have the industrials, you have value plays, you have growth play, right? So the stock market really is a market of different sectors. Now, what if I told you that prior to the market carnage that you see now, you actually do have certain sectors going into the bear markets already? What sectors are those? The growth market, the small caps. Before the main segment went into the bear markets, the small caps, the growth caps went into a bear markets, months before them. Now, when the stock markets eventually recover, we believe the small caps and the growth stocks will be the first to recover, well ahead of the S&P, the industrials and the bigger cap stocks, right? So if you were to ask me, what stocks am I looking at? I would say the small cap quality growth stocks. Now, these stocks are the most sensitive to interest rates. And when the central banks start to pivot dovish, these are the stocks that will rally. They will be the first to rally.
Okay, so you kind of answered my next question, which is strategies to navigate the current investment climate, right? On top of dollar cost averaging, that's what investors should look out for, these small cap stocks. What else? Is there any other advice?
Well, I would say believe in your investments, This is the reason why we advocate the investor doing extensive research. Because when you research a stock or you research into a sector thoroughly and you believe in your research, you tend to want to hold them. You tend to persist in those stocks, right? And even if volatility does come in, you believe in them enough to hold them through the volatility. I would say the market really moves in a cycle. When it goes down, eventually at some point it will go up, right? It moves in a cycle, okay? So things may look gloomy, right? There's gloom, there's doom, but believe in what you have researched in, believe in the sectors, believe in what you have the research you have done, and wait it out. Eventually, we believe, like for example, as we spoke about earlier, the central bank will pivot because of these inflationary pressures. Stocks will rally at some point, and then all you have to do right now is just to hold on.
Okay. What can you tell me about the Recession Buy Indicator?
Okay. The Recession Buy Indicator is a theory developed by economist Norman Forsbeck in the 1970s, right? Now, it is backed by 150 years of data, right? Essentially, when the indicator is triggered, stocks produce, on average, a 100% return over the course of the next year. So that's a recession buy indicator for you. Generally, you buy stocks or you invest into stocks 7 months after the US has gone into a recession. Now, generally, recessions last about 14 months on average, generally, right? And 7 months into a recession is where the trough is. That is where the recession is the deepest. Okay, so when you buy into stocks during a recession, the Recession Buy Indicator points to you that generally you make about 100% return the next year. For newer investors, this period will likely be a very terrifying time for them to invest, right? Because for the first time, they see drastic volatility. Okay, and my advice to new investors would be to invest in an amount that they don't lose sleep over. If you are investing an amount that causes you to lose sleep at night, you're investing way too much. Now, for the more experienced investors who have gone through a market turmoil, like the 08, financial crisis, and the dot-com, even the dot-com, holding cash is a smart play, but at some point you need to deploy them. At some point when stocks are cheap, stocks are dirt cheap, like where they are now, you really need to start deploying cash to buy great companies on the cheap. That's my advice, Roshan.
Well, I really enjoyed this insightful conversation. It was quick, and I think we should catch up again, maybe next year, 2023, see how the markets are doing. I'd really love that.
That'd be awesome, Roshan.
Fantastic.
Right.
Thank you so much.
Thank you so much, Roshan.